We are back with our January update of this series that we started about a year and a half ago now. At the time, if you recall, the markets were going through quite a downturn. So the question I asked at the time was, if we look at some historic metrics, some historic signals, what clues can we get to see whether the market had bottomed out at the time? In the last video, last month, we revisited some of the examples from the earlier videos. And if this is the first time you've seen this, if you're new to the series, I would suggest very strongly that you go back and look at the previous month's video first, because that'll give you a lot of context in helping you understand what we're looking at here. The most important thing is here, we're going to look at 6 metrics, but they are individual, one at a time. The important thing is that you look at these in aggregate. One of them won't tell you the story, but if you see a whole bunch of them moving in the same direction, it can give you a clearer view. We're looking at the data, we're assessing the data, we're using history as a guide. By the way, if you want a market update, I will put a link here for our Pulse newsletter, which we put out every Saturday morning, every weekend, and that will keep you up to date on the latest news, the trending information that you need to know to keep up to date. Also, everything we do on our YouTube channel here is available on podcast form as well. Now, at the last update that we did, which was for the month of December, you will recall that the major markets were still very much in that Santa Claus rally. Everything was moving in a very positive direction. Well, when we look at January, things did slow down. So this is the month of January. Things slowed down, but everything did, the major markets that we covered did in fact end up in positive territory. They were looking good, a bit of a tail there, but at the end of the day, they were in positive territory. When we look back over a 1-year number, again, number strong across the board. The NASDAQ leads the way. The TSX is in 4th place there, but just slightly into positive territory over that 1-year period. So what is happening today? That's the essence of this, updating where we're looking on these metrics. So we're going to start where we always do, and that is with the yield curve. When we look at this chart from last month, we see the blue line, which is the US 10-year 3-month yield curve. The orange line is the 10-year 2-year. When we look at these, we can see that they're both in negative territory. And the key here is that historically, when these yield curves have gone negative, they have to go positive again before we see the worst of the market conditions out there, typically leading up to a recession, again, using history as a guide. When we look at those today, there's no material change. They're both still in negative territory. So as I said, history will say that we're just getting closer to that recession or that correction at a minimum, not past it. The curves go positive first, then the market corrects. So last time I gave a verdict here, my answer was no. This is saying there is more pain to come, and my verdict this month, just going by this one metric, is no as well. I'll move on now to the moving averages, and for this series here, I use the S&P 500 with its 200-day exponential moving average. The last update, the blue line here, we can see that is the S&P 500. That was sustained above the orange line, which is that 200-day exponential moving average. We see that it's been holding up there for a couple of months, but not years. And when we look back to what I looked at last month's video, the updates there, we can see that typically for this to really give us a signal, to confirm a signal, it has to be a much longer time period than just a couple of months. But we can see on this chart again that we have seen just this past couple of months since it broke out above the 200-day average again. Now we can see if we look back almost a year ago now to March, for the most part, that has been trading above the moving average. So there was that little blip back in October, November of last year. When we look at it today, well, I would call this full steam ahead. We see again that we're closing in on that 1 year above the blip. Is it too early to tell that we can confirm this? Well, let's have a quick look here at the 5-year number. This gives us a better indication. We saw from 2020 right through till about January of 2022, we saw a very sustained increase above there. So that's kind of what I want to see again this time here. Now, the result for this month, the last update I said maybe. Again, I'm looking for months and months and months of confirmation, but we could be there as far as this indicator is concerned. I'm sticking with that metric that verdict for this metric this month. So I'm going to say that as far as the moving average indicator is, that we're saying maybe we have seen the worst. I want to move on now to the volatility index, the VIX, and this measures market fear and uncertainty. Last time we looked at this, it was holding in the low to mid-teens. We've seen that for the most part. You see that white line there? That's the longer term average. So for the last long time now, we've been underneath that. January, well, pretty much the same. Extended pretty much in the sideways area. We ended the month with a measurement of about 13.87. So the markets out there are saying, hey, we're comfortable. The experts who are using these futures to predict what's happening here. The last verdict, I called it a cautious yes, saying, hey, this indicator of itself is saying, yes, we're good now. I'm going to stay with that cautious yes. I am going to put that little proviso in there. Now, the U.S. jobless claims is the fourth metric that we look at here. And we want to see a noticeable drop in those applications. If we look at the last report, we can see that there had been a slow gradual decline since about June of last year. Well, since our last report, we have seen that number spike up again. So that's not very reassuring. When I look at what the U.S. Department of Labor says in their latest release, they say in the week ending January 27, the advanced figure for seasonally adjusted initial claims was 224,000, an increase of 9,000 from the previous week's revised level. The 4-week moving average was 207,750. That's an increase of 5,250 from the previous week's revised average. Now, I do update this series every month, but those numbers come out every week. So I'm just looking typically at the most recent prior to shooting the video here, typically the first week of the following month. So when I look at these numbers, I don't see anything that's obvious. I do look at that moving average because that kind of it gives us a bit of a smoother look at things. It's still rising, so it doesn't give me a whole bunch of confidence there. The last update I looked at this, I said the answer to this was no. We do still want to see that number, that drop in those initial job claims come down. My verdict today is consistent with that. I'm going to stay with no. We are seeing that. That's just my verdict for this month. I'm going to say no. More bad news to come. I guess that's the best way to describe it. Now, the fifth metric is the Baltic Dry Index. And on the last update, we had seen that the index had moved up, that orange line here. That's generally a good signal. That's what we want to see. But then it pulled back later in the month of December. Well, since then, we've seen that pullback being extended. We can see now that we're through the month of January, we can see that BDI trading at quite a significantly lower level than it was just a couple of months ago. When I look at the Marine Link website from last month, a couple of articles that kind of stand out to me here. We can see on January 12th, we can see the Baltic Dry Index marked its worst week since 2008. This is a weekly measure, but that's doesn't sound great. And then when we look at a week later at January 18th, we can see that the BDI did snap that 8-day losing streak. But I guess the key here is the fact that it was on that losing streak. So if we look back here at that chart for just a minute, we can see the behavior there where we've seen signs of improvement, but each time we've seen that they've pulled back. When I look at the last date, my verdict was maybe, and I'm sticking with that for this monthly update as well. I'm going to say maybe. I don't see a strong signal, actually, either way. So to have more of a conviction in what this is telling me here, I would need to see something more definitive. I just don't see that. Moving on to the sixth metric now, that is the PMI, the Purchasing Managers Index. And this is a pretty simple number here. If this number comes in above 50, that means that the manufacturing sector of the economy is growing. If it's below 50, it means that it is shrinking. With the last video, the December PMI was at 47.4. Today, we see that up to 49.1. So I see that as a positive. Now, we have to be very careful here because the 49.1 still means that the manufacturing sector shrunk, but it wasn't in positive territory, but it shrunk less than it did the previous month. So that's how we kind of interpret that there. If we look at what the Institute for Supply Management website says, they say the U.S. manufacturing sector contracted in January as the manufacturing PMI registered 49.1%, up 2 percentage points compared to December's seasonally adjusted reading of 47.1%. And we can see on this chart here that most recent improvement there. In their commentary, they also say, though, that this is now the 15th consecutive month of contraction. When we pull this back, we can see how poorly this portion of the economy has been performing. For context, when we look back to the early 2000s, and I get it, this is just one snapshot in time, but it does give us some indication of what might be to come. The stocks declined here well past the PMI bottom. We can see the orange bars there where the PMI bottomed out. We can see that blue line being the S&P 500. We can see how that dropped significantly down past the bottom of those PMI numbers. So that certainly is not a guarantee of anything yet to come. None of these numbers, as I said before, well, none of them independently are a guarantee. None of them even in aggregate are a guarantee. Market moves in strange, mysterious ways sometimes. But I look at history and see definitely some rhymes here. Time will tell whether, in fact, we have, whether in fact this bodes well or poorly. Only time will ever tell that. So I'm going to say for my verdict this month, the answer is no. We probably have at least some shakiness, some uncertainty left to come. So when I look at those in summary, the yield curve, my verdict is no. The moving average, I put a maybe there. The VIX, yes. The jobs, no. The BDI, maybe. And when it comes to the PMI, I'm saying no. That will not, there's more shakiness yet to come. Let's just sort of summarize it at that. Quick reminder here that we do have our Monday and Wednesday news segments that comes out on this YouTube channel. You can subscribe and make sure you're up to date on all of the trending news there. Also, we do have our Weekend Pulse newsletter. Encourage you to subscribe for that. Have a look at it. It's kind of a fun newsletter. I try and write it in a design that it is informative, but also kind of lighthearted and fun as well. We cover all the latest trending business topics. I will put a link to the playlist in this video here. As always, I will also put a link for our Investing Academy. I would welcome you to visit us there as well. That's it for this month. Thanks so much for watching. I will see you in the next video.